Good morning, everybody, and welcome to the second in this series of webinars on global equity investing. How timely that we should be thinking about global listed markets at a time of geopolitical uncertainty. And so it's extremely apposite that we're going to be thinking through both the immediate geopolitical issues that face investors today, and also, just as importantly, some of the deep underlying strategic changes that are occurring in markets. It's a pleasure for me today to be joined by Andrew Pease from Russell Investments and Chad Heitzman from GlobalX. Andrew was previously the chief investment strategist for Russell's in London, and has recently returned to Australia, where his role is head of investments Asia Pacific. Chad is the head of institutional sales for GlobalX, and will be known to many of you as a participant in many of the IMAP webinars, and brings GlobalX's view formed from their broad exposure to markets. Before I hand over to Andrew in the first instance, let me just say a few words about IMAP's upcoming events. This is a very busy year for managed accounts as we approach $300 billion in FUM, and for those who are involved with MDAs in particular, as the MDA instrument will be rolled over by ASIC later this year. So coming up through the next few months, we have IMAP's Portfolio Management Conference in March, in Sydney on the 19th of March, Melbourne on the 27th. Then at the end of July, Advice in Action, where this year we'll be focusing on giving advice to high net worth investors, the requirements to deliver portfolios for investors who are typically more complex in their needs. In September, IMAP will again be hosting a session at Sydney Alternatives Week, where we'll be talking about discretionary portfolio management and the role that alternatives play in that market. In October, Independent Thought Conference, where we showcase the thinking of our leading portfolio managers and asset consultants. And then picking up on the MDA theme for the first time this year, we'll run an MDA Providers Symposium. So ASIC have said that they expect to release the MDA instrument in October. We'll give it a few weeks to sink for the implications of any changes that they might make to sink in. And in November in Sydney, we'll be hosting a day-and-a-half summit on MDAs and what those changes to the instrument might mean for practices for whom the MDA structure is important. Tomorrow, the third in this webinar series, we'll have Andrew Stewart from Mercer, Tom King from Nanook, both addressing this issue of global equity investing and the issues that the current geopolitical environment have created for them. So now it's my pleasure to hand over to. That's not what I was anticipating. Let me just stop sharing it for a moment. Go back and recover our slide deck here. It's right. Let's try again. It's my pleasure to invite Andrew Pease, who, as I say, is head of investments for Russell in Asia Pacific, to talk to us about the issue of global equity investing. Andrew, over to you.
Thanks, Toby. It's good we got the slides back up, but slides are overrated in the first place, so it wouldn't have mattered if we didn't have them. But we'll use them anyway since you have them up. I've got, I think, about 5 to 10 minutes. I want to talk about four things. I want to talk about factors, because that was one of the things we're asked to talk about. Russell investments, we're big on factors. The second thing I want to talk about is artificial investment and investing, and what does that mean going forward, and how that affects portfolios. I think it argues for broad diversification rather than trying to pick winners. I'm going to talk a little bit about dilution governance, corporate governance, what we're seeing in China, what we're seeing in Japan in particular, and how that makes those markets look more interesting than that otherwise would be. I'm going to talk quickly about emerging markets as a theme going forward, which how it's related to US dollar weakness. And then, because it's such a big topic, I don't think we spend enough time thinking about it. I'm going to spend a couple of minutes at the end talking about how to think about currency hedging in your global equity portfolio. It's a big deal. You should have a clear thought process about how you think about the hedging decisions that you make, because get it right, it helps a lot. Get it wrong, there's a lot of regret involved. But let's start with factors first. So this is how we think about equities in the Russell factor world. In the Russell world, we think about factors a lot. And the ones we like are value, momentum, quality, size, volatility. Growth so much. Growth is more of a tactical call that we let our managers get into, because we know that over time, growth stocks don't have a long-term track record of outperforming the broader market. But we certainly think that having an allocation of values, good, cheap stocks, momentum stocks do generate higher returns over the market. A really unloved factor right now is the quality factor. Firms with really great balance sheets, the high quality stocks, they've been carted out by the market over the last couple of years, but we're sort of thinking that there could be a time over the next few years where those things really start to come back, and we think that small caps and mid caps can actually pay off. And we also like, particularly heading into defensive periods, lower volatility stocks. So I don't want to spend too much time on it, but that's generally how we think about building equity portfolios. We start off with thinking about how we want to build our factor exposure in each particular product. Let's go on to the next slide, because I think this is the one which is really worth talking about, which is artificial intelligence. What's it going to mean for portfolios going forward? And I think what it means for portfolios going forward is you want to be very broadly diversified. Do not chase the current winners. And it is interesting that all of the Mag 7 stocks now are in negative return territory so far this year. So what do I mean when I say who wins from AI, creators or users? Well, I think compared to the 2010s and the 2000s, the winners in an investment sense from technology were the creators of technology, the Metas, the Alphabets, the Microsofts, the Apples. These were the companies that had the big gains. Why do they have the big gains? Because they had two things. Traditional tech has two things. It has network effects. The reason why you use Facebook, the reason why you use WhatsApp is because your friends are on there. The reason why you use Amazon is all the stuff that you want to buy is there. Network effects give you quasi-monopolies. To use the tech jargon, it gives you a moat. The second thing these companies had was they had amazing economies of scale. It costs Meta almost nothing to add an extra person onto Facebook. It costs Microsoft almost nothing to stamp out an extra version of Office 365. So these were free cash flow making machines, which is why they had such high margins and still have such high margins, and have been able to maintain such high valuations. But what about artificial intelligence? Are there network effects? I'm struggling. I've been trying to use one of them. Everyone's very excited right now about Claude. They were excited about ChatGPT 5 a while ago. They look very similar. They're all using the same technology. They're just trained slightly on different data. So, the fact that you use an AI, you're not using it because your friends are on there. You're using it because it solves the problem that you've got in front of you. So, no network effects, cost of extra customers. Well, data centers, electricity. It's insanely expensive for a lot of these AI companies to scale up. So there's no economies of scale. So what industry does it look like? It doesn't look like the great tech industry of the 2010s. it actually looks a lot like airlines. We wouldn't have a global economy without the airline industry, but they're commoditized. It's a high capex industry, low margin and very cyclical. And that, I think, is the future for artificial intelligence investing. Artificial intelligence will change the world. There's no doubt about it. But you want to invest, instead of the 2010s, where the creators were the ones you wanted to invest in, I think in the late 2020s and into the 2030s, you want to be invested in the users of AI. That's where the gains will be. And when I said we don't have a moat, that refers to that email from Google that was leaked in 2024 where they said, we're scared, we don't have a moat. That is, there is no monopoly, no quasi-small monopoly in AI because, as we saw with DeepSeek, your lunch can be eaten very quickly by competitors. So I think AI is going to be commoditized. There's going to be too much of it. It's not going to be the best investment, but the companies that show skill at using AI the best, they're the ones that are going to generate the best return. So instead of being concentrated in tech stocks, which would have been the best thing in the 2010s, in the next 10 years, I think you want to be broadly diversified. Let's move on to the next slide. Corporate governance matters. And I put China up here because I think it's the best example of all. Now, we all know that China's economy is in the toilet right now. It's not coming back anytime soon. But what happened to investors in China? Because China went through this golden period where it was generating huge amounts of earnings. So what I've got on the left here is I'm showing the share count. And what's happened with China is that China as an economy, with the chart on the right, you see the total earnings in the blue line, has produced massive profits over the last 20 years. But the problem is investors have seen nothing of it because of the dilution. There's been absolutely no growth in earnings per share. But over the last 4 years, we have seen a change. We've seen buybacks. We've seen less share issuance. Even though total growth, earnings growth is much more meager than it was, we're still pumping out 6, 7, 8% EPS growth now. And I think that can continue in China in certain sectors. So even though I don't like the Chinese macroeconomy, I think the idea of China as an investment market is still a viable outcome. Let me move on to the next slide. Moving more on to the emerging market story as well, because that's the other one which is related to it. I forgot to mention, in terms of the corporate governance story, my favorite corporate governance market right now is Japan. I think Japan ticks so many boxes right now in terms of investment, but in terms of corporate governance, what we're seeing with buybacks, what we're seeing with these intertwined shareholdings being unwound, the kiritsus coming disappearing, Japan actually stacks up very well on this corporate governance front. Let's go on to the next slide. Emerging markets. Emerging markets always promise high returns, you know. They're risky, they're growing fast, of course they're going to return. Anyone who's owned emerging markets for 30 years has had absolutely no return. Emerging markets have been a terrible, terrible investment. Partly it's because of the governance reasons. I think that is starting to change now. Maybe not so much in India, but certainly in places like China. But the biggest driver of emerging markets performance is the US dollar. There is a very well-defined correlation between the US dollar, and in this chart, the orange line is the trade-weighted, inflation-adjusted real US dollar. It's inverted, so when the line is going down, the US dollar is going up, and when the orange line is pointing up, that means the US dollar is weakening. So when the US dollar weakens, emerging markets do well relative to developed markets. When the US dollar is appreciating, as it has over the last 15 years, that kills emerging markets performance. And I won't go into the details. A lot of it's got to do with how EM central banks link back to the Fed, and a lot of that comes through the role of the US dollar. The important point is we've seen a turn in the US dollar. I think the US dollar is going to be on a trend downward point, at least over the next 5 years. And I think that creates a good case now for, at least on a cyclical basis, expecting emerging markets to do relatively better than they have. And we've already seen that over the last 3 to 6 months. And finally, my final slide is one of the things I think we all have to think really carefully about is currency hedging. When you buy global equities, you always have a decision, do I have them hedged or unhedged? And there's a few things. If you don't want to worry about it, always go 50-50. Least regret, if the Aussie dollar goes up or down, you don't mind. There is an argument, and it's an argument that makes a lot of sense, that when you buy global equities, you probably should always do it fully unhedged. And the reason is it helps diversification, because we know the Aussie dollar is a risk-off currency. If we have that financial crisis again, or that bad share market event, the Aussie dollar will fall. That will mitigate the losses, really reduce the losses that you're making on your unhedged global equities. But there is a case right now with Australian interest rates being higher than US interest rates. It's a technical argument based on a thing called forward rate bias. But normally, and we saw this before the financial crisis, when Australian interest rates are higher than US interest rates, and they're forecast to stay that way for a while, you actually get a slight premium. You get paid to hedge, which is always a nice thing. So that argues for having a higher hedge ratio. The one which we like a lot, which we put a lot of our clients into, is dynamically adjusting the hedge ratio. And we've been doing that a bit in our funds too. So we were really heavily hedged when the US dollar was when the Aussie was at 60 cents to the US dollar. We're basically neutrally hedged right now because we're pretty much at fair value against the US dollar at 71, 72 cents. And then if we get up to 85 to 90 cents, I think we'd really be cutting our hedge ratios much more. And the final one, which matters a lot in the institutional world, less so in the advisor space, when we're getting measured in those performance tables against our peers, given that the Aussie dollar and currencies are the hardest things to forecast, a lot of the time you just want to be not too far away from where your closest competitors are. But I think I've used up all my allowable time, Toby, so I might pause there.
Thank you very, very much, Andrew. We'll be coming back at the end of Chad's presentation to talk a lot more about the issues in Iran and more importantly, how an event like this and the uncertainties that are incumbent on the US and Israel attacking Iran, how they might be interpreted by portfolio managers. So we'll be talking about that in just a moment. But now it's my pleasure to hand over to Chad Heitzman from GlobalX for their perspective on global equity investing. Chad.
Perfect. Thank you so much, Toby. That was brilliant, Andrew. So today we're going to be talking about our overarching view for equities in 2026. On slide 2, I'm Chad Hitzeman from GlobalX. We're a multi-asset ETF provider offering ETFs over equities, fixed income, liquid alternatives, and much in between. On slide 3, before we begin, as something of an obligatory statement on recent event risk geopolitical ones with respect to the U.S. vis-a-vis Iran, I will say a few things because Toby has asked us to do so. The higher order bird's eye view from my standpoint is this. Geopolitical competition, that is security competition, is structurally persistent for a variety of anchoring reasons, one of which is the presence of a more multipolar international order. And within this, and attempting to ensure that U.S. deterrence isn't eroded or imperiled, potentially inviting and incentivizing bold behavior on the part of U.S. peer competitors, the current U.S. administration, since Inauguration Day 2025, is rapidly standing up a deterrent structure toward peer competitors, such as China most immediately and Russia. And by doing this, through enacting demonstration effects, number one, such as Iran in June 2025 and wiping out Iran's nuclear facilities in Fordow. Number 2, in January 2026, the U.S. capture of Venezuelan President Maduro. And that action, by the way, in Venezuela, moreover, coincides with a restoration of what is referred to as the U.S. Monroe Doctrine in the United States. So throughout its near abroad in the Western Hemisphere, the U.S. exerting power. And now, fast forward to today, number 3, we have March 2026, U.S. action toward Iran and the decimation of Iran's regime, Air Force, Navy in large degree. Cuba as another point of contest and change is something to track moving forward. But what does this most immediately mean for asset markets in a general view? I would say geopolitical competition often leads to flare-ups that impact asset prices, sometimes on a temporary basis, other times on a more protracted basis. Areas like commodities such as energy and oil can be affected. Almost everyone here on the call today will intuitively know the geopolitical significance of commodities. So perhaps having some broad commodity exposure in a portfolio, which is geopolitically sensitive, may make sense. So having assets that historically register and react to geopolitical risks in their price action may make sense. Or maybe having exposure to defense technology companies may make sense in the current environment. Otherwise, reassessing your risk tolerance and potentially geopolitically exposed positions is something to do. But all in all, I would say there are numerous equity areas that we're confident in, despite geopolitics or perhaps because of geopolitics. And some of those areas we'll speak about today. On geopolitical risk, I will note that last night it appears that Iranian event risk is isolating to assets where traders think there could be an inflation impulse due to higher oil prices. So US bonds sold off moderately, but risk assets, in fact, like the NASDAQ 100, Russell 2000, and Andrew mentioned small cap universes. So the Russell 2000, that was up. But I expect Iranian related inflation concerns to wash out if ultimately Iranian event risk is managed and OPEC is able to bring additional barrels of oil online to offset any disruption to energy markets. It's lastly interesting to note on this that Bitcoin was moderately up last night. So perhaps there's an expectation that black market rogue nations and personnel will funnel funds into Bitcoin out of concern of heightened US foreign action. So something that can be referred to as the sanctions effect, positively impacting Bitcoin's price. But putting all that aside, fundamentally, it's important to always keep in the forefront of your thinking that earnings growth matters most in the long term for equity performance as the principal item to track. Now, with that out of the way, let's rapid fire fashion run through 3 points we're highlighting today. So number one is that there's indication of global resilience in terms of a cyclical upswing, perhaps most favorable for Asia, even including Australia. So hence the Australian dollar as that risk on currency in part is rallying. Number two, much of what we're seeing are instances of equity rotation and equity broadening. In other words, rather than frame this discussion, as has been in vogue recently, as an end of American exceptionalism, we more neutrally and less dramatically frame it as normalization. For years, US assets have outperformed from currency, equities, fixed income, and now we're having better signs of life in global equity markets, which started actually last year, and that is healthy. And the last thing we will cover off are a few thematically specific equity areas we wanted to highlight, such as Japan. So that actually is parallel to Andrew's thinking, and other ways to play artificial intelligence, such as through AI infrastructure and copper miners. So on slide 5, let's dive into it. On an aggregate global basis, the world economy is expected to grow 3% this year, roughly 3% next year, roughly. Those are the estimates. In making up this global aggregate, we've listed on the left several key economies and their expected growth, encompassing developed markets, emerging markets. It's worth highlighting that the policy backdrop of central banks, if any unforeseen exogenous shocks occur, they have apparent policy headroom to bring policy rates, cash rates down meaningfully. Though on another note, I will quickly mention, in the presence of any dislocation, on the other hand, the degree to which fiscal policy can provide stimulus in the event of any shock, beyond conventional measures like automatic tax reductions and so forth, that might be constrained compared to COVID experience. So that's something to keep an eye on. On slide 6, asset markets have been normalizing through country rotation, some rotation from DM to EM, from US to non-US, even some factor rotation, with indication, for example, so far year to date, global value outperforming global quality. In saying all of this fundamentally, however, for this theme of normalization and rotation to be sustainable, these other non-US areas into which capital is moving have to perform on an earnings basis, especially with regard to the US. So to put that quickly into perspective, for last year, 2025, non-US developed markets did outperform US equities. Yes. China as an EM destination outperformed US equities. Yes. But nevertheless, in terms of earnings growth, developed market, non-US, broadly measured, was only approximately 2%. China's earnings growth, broadly measured, was negative. The S&P 500 earnings growth, approximately 12%. Another characterization of 2026 then could be this, that this year for non-US allocations within this rotation story, they have to now validate themselves with evidence of comparatively stronger earnings growth. Otherwise, there can be givebacks to prior 2025 outperformance. On slide 8, let's put this into perspective a bit more. In 2025 on the left, we show the relative total returns of developed markets, emerging markets. The US, while clocking a return of 18%, was outperformed by countries such as Korea, Japan, China. And on the right, we see these rotations in terms of ETF flows, with the flow to US equities calming down a bit throughout 2025, with this shown by the orange color of the bars being the US, with this subsiding a bit. I think you got ahead of us a little bit, Toby, but that's okay. On slide 9, as we see rotations to other developed markets and emerging market equity destinations, we're seeing stronger earnings revisions going into this year. For non-US equity markets such as Japan, such as India, and even Australia, which is shown on the left. All the while, this is playing out in a context where US equity valuations have been relatively historically high. And the point is, on the right side there, is if you can find source companies with strong earnings per share growth at reasonable valuation, so in effect a GARP opportunity, that seems sensible. So running a growth at a reasonable price equity allocation, being a middle of the road growth and value factor play, may be sensible in the current environment. On slide 11, in terms of quickly canvassing the opportunity set and some examples here, number 1, Japan. And for Japan, it's reform, reform, reform that matters. And this means, among other things, Japanese companies prioritizing through governance changes, shareholder value creation, through initiatives like buybacks, dividends, and increasing accountability to shareholders in respect of prioritizing return on equity, so efficiently using capital. And you can see on the left the blue line denoting buybacks increasing in Japan, and the orange line denoting increasing dividend yields in Japan. And on the right, the equity index in Japan that has had a strong exposure to some of those factor returns, that say buybacks and dividends, has been the Topex 100 as one Japanese equity universe to cover when investing in Japan. On slide 12, next opportunity area we feel is AI, but investing in artificial intelligence on, let's call it, an adjacency basis. So into AI infrastructure components. Within the AI thematic, there have been winners year to date, but in areas adjacent to FANG names. We like to say that while chips and software dominate headlines, the physical backbone of AI, including power grids, thermal systems, and connectivity, remains underappreciated. But these AI enablers are becoming critical as AI scales in size and complexity. So energy equipment manufacturing companies, for example, is one play. On slide 13, even basic materials inputs such as copper is another adjacent AI play that investors can cover. So copper is central to an AI build out because AI is electricity intensive, it's bandwidth intensive, and copper is that physical medium that moves power. So if estimates prove forwardly correct, data center demand for copper will assume an ever larger proportion of the overall demand for copper. And finally, very finally, on slide 14, we're showing the ultimate problem with respect to copper, and that's copper supply is mismatched against AI-driven demand for copper. So therefore, covering copper miners is another way to play adjacent areas to AI. So having a basket of miners such as, say, Freeport, Southern Copper, BHP, and Glencore is another adjacent play on AI. So that's that in a rapid fire fashion. Thanks so much, Toby.
Thanks very much, Chad and Andrew. So, look, let's Chad and Andrew, if I can ask you both to join us now, let's talk about Iran, and not so much what you think is going to happen, but more how an event like this plays out in the way you think about portfolio construction. Andrew, uh, how for Russell has this been sort of absorbed at short notice, and how do you think it will play out in the way you think about portfolio construction and manager selection?
So I spent most of my Sunday on phone calls talking about this with the global team. But like you've got to be careful. Like you always got to think about two things. There's the strategic side and the tactical side. So the tactical side is important, and quite often when you get these events, we saw it with Liberation Day, that you get last year, where you have a big sell-off, and that creates an opportunity to either rebalance your portfolios in the multi-asset world, or sometimes, like we saw in 2020 during COVID, it gives you a chance to explicitly go risk on, because you can see investors are panicked, there's been an overreaction, values come back, and you know that the cycle isn't going to be nearly as damaged. So people do naturally overreact on these events, which we haven't seen this time. We haven't had the big overreaction yet. So the one level is we're watching if markets do dislocate enough. I showed that sentiment index before. If that was to move into the panic zone, and I think that's only 3 to 5% away in terms of market drawdown, that would actually get us quite interested about maybe just leading the portfolios into this as a tactical call. But there's a broader strategic call, and Iran doesn't really change that much. Like there's been this view for a while now. What do we know about the US? It's running 7% of GDP deficits for as long as the eye can see. So we know that there's a lot of risk coming out of the United States right now. They're running a massive current account deficit despite the tariffs. So it feels like the period of US exceptionalism is over. And I know there's a debate, and I think Chad summed it up a bit, which is maybe everyone will want to invest because it's going to be the best economy, it's got the best tech. Well, my argument is tech's not going to be the investment winner going forward. Tech is going to lift all the boats, and you want to be invested in all the boats. So don't chase the tech. And I think the market's going to be very hard pressed to buy into the US given those fiscal fundamentals with an expensive US dollar. The US dollar is going to be weakening. So what do? You invest globally. So we know the world's a more dangerous place than it was a few years ago, but you know the world's always been an uncertain and dangerous place. But you take a diversified portfolio, you buy your equities, get your European exposure, get your Japanese exposure, be sensible about how you're doing your EM, get your infra, get your REITs, have a good private markets allocation. That's the portfolio that you want to be in. You don't want to be trying to pick what this is going to mean and what the right geopolitical outcome is going to be, because geopolitics creates the environment. And so all that we care about when we invest is we care about earnings, their volatility, and what price you're paying for them. That's all we ever care about. Geopolitics creates the environment in which those things happen, so it matters for that. But we're not at that stage yet where geopolitics is going to undermine the investment case. I think what it's telling you right now is you just want to be broadly diversified. There will come a time when geopolitics matters a lot. That will be when we really have the clash of the titans between China and the US. We don't know when that's going to happen. It may never happen, but it's still a long way away. So for the next 10 years, and we've been thinking about this, we're putting a paper out on it at the end of the month about asset allocation for the next decade. You just got to hedge your bets a bit more. Don't buy the last winners. Look to where things have got value, where the growth is going to be, where the earnings are going to be. And I think that's going to be the best portfolio.
Chad, I mean, obviously for you as an ETF issuer, that these and not a portfolio and not an asset allocator or portfolio manager yourselves, the issues are probably second order issues. But for Global X, how do you think about these types of geopolitical events?
Okay, so there's a few things to itemize. Number one, I would say just teeing up the conversation. Just imagine a world in which the United States as the military backbone is not present. So I think as a thought and experiment, that would be very interesting, which is to say, I think that geopolitical competition is very visible, very real. Industrial competition is very visible, very real. So we think it's actually playing out as we speak. hence tariffs and things of this nature. As an immediate example on China's side with regard to electric vehicles, they're selling at under and beneath marginal cost to saturate the global market. And that's a part of a strategy. In response to that, of course, the United States has a tariff wall. The EU on their side have tariff walls and so on and so forth. So, and you mentioned current account deficits and things like this. There's major imbalances in the global economy that need to be resolved. And so I think U.S. policy on that side of the thing is side of the fence is attempting to alleviate those imbalances. With respect to debt and deficit concerns, I think they've overshot, if I may say. And the reason I say that is, as a matter of fact, at least presently, U.S. fixed income, sovereign fixed income has outperformed G7 peers. So if I thought that there was going to be a radical selling off of U.S. asset that marked an extreme end to U.S. exceptionalism, I would want to see the U.S. dollar extremely selling off, and I would want to see U.S. bonds extremely selling off in tandem. And I don't think that's necessarily happening. I think what we're having now is normalization. As Andrew said, with the US dollar normalizing versus its peers on a DM basis, on an EM basis, that makes it attractive to look into other markets. As US rates come down, it makes it attractive to rotate in other markets. So I think that's how we think about it, on our side also for quite some time now, post-COVID. We do have assets, and I refer to them as those that historically register geopolitical risk. So most immediately as a liquid alternative, gold. That has been thriving as a barometer of that risk level. Always being broadly diversified, I think, is an axiom. Broadly diversified with regard to your equity bucket, with regard to your fixed income bucket, with regard to your liquid alternatives bucket. So that's kind of how we think about things. There's a lot of fluidity going on. And if you continually have panel discussions that a lot of our attendees, I'm sure, are listening into that always recurrently mentions geopolitics, I would say it's probably for a reason. And I enumerated some of those geopolitical events, and they do seem very exceptional. But in saying that, I will say this. Even in a context of geopolitical instability, the market tends to find equilibrium. It usually does. Even after Russia incurred upon Ukraine, the market digested that, and now we're in something of an equilibrium, at least vis-a-vis that event risk for now. So even where and when we do have these event risks, the market can still find forms of steady states. But being broadly diversified, I think, is a good thing. And we mentioned Japan as a key interest area. Artificial intelligence and some of those ancillary areas are interesting. And, in terms of AI, just quickly, commoditization does seem like something to watch, as well as the risks of that CapEx expenditure. But, we do feel as though there's limited players, actually. So when you say commoditization, I can see how I know what you mean by that. But matter of factly, there's only limited players in this game. And on a deep seek level, I don't think there's much commercial viability within that model anyway. And I also think that, very, very lastly, that in this contest between the United States and China principally, that one thing to watch for is technology rapidly advancing. The exportation of technology and the importation of technology is going to have to be screened on national security terms in large degree. So even if you have, let's say, Chinese robots rolling out and they look very impressive, the total addressable market might be limited in as much as there's import restraints, say in the US, on technology like that, precisely because it's so high tech. It has national security concerns. So hopefully the United States and China can have a managed relationship. We can find a steady state and progress that way.
So does that mean, and Andrew, I'd be interested in your thoughts on this. Does that mean that Iran, we should be seeing Iran almost in the context of a sideshow? I mean, it's unpleasant if you're Iranian. It's almost certainly unpleasant if you're if you're from the Gulf states and worried about drone attacks. But the main game is the US-China conflict and how that plays out in the political, the economic, and the military spheres.
I think so. Like things have to get a lot worse. Like they always could, of course, but like you'd really need to see the oil price to get up to $130, $140 a barrel before you start seriously worrying about recession risk, and it would have to be sustained. And like the world is just so less energy reliant than it was 50 years ago. The amount of oil price increase you need to make a serious dent in GDP is quite large. And remember, so I think this is something which is more noise than anything else. And remember, President Trump has the midterms in November. Like, yeah, he's not going to do anything that's going to cause an upset on that. Like, sure, things could spiral out of control. But the more broader thing is the world has changed a bit. Like, there are two major powers now. How does that play out going forward? But again, I would sort of be careful about overemphasizing that about how we build portfolios. Ultimately, we build portfolios because we believe in income streams. We price those income streams. We see the risks around those income streams, and that's always what it comes down to. So that's why you are looking in. The US has been great. Europe is picking up now. I think Europe's got a much brighter outlook than it has for quite some time. We've talked a lot about Japan. Japan looks very good. China, maybe not so much. India is an interesting place. So there's lots of interesting places to build a portfolio around. But the point is, don't think that, and I certainly don't think that I've got the ability to out forecast other people as to which one is going to be the best. What you do is you build up your strategic asset allocation, and then you hire the experts that at Russell we use, outside advisors, multi-managers, and we pick who we think are the best at managing those to get the extra returns, which is what delivers the extra portfolio power.
Well, to that very point about multi-managers, so at an event like this, or Liberation Day, or in the event, for example, that China attacked Taiwan, or there was conflict in the South China Sea, to what extent do you leave the managers to get on with it because you've picked them and they've got the money, so to speak, or do you expect them to have a view which is broadly consistent with your own view at a time like that?
No, we don't. Like the managers are there for their security selection view, and like we've been analysing managers for decades. Like the last 30 or so, we've been analysed managers over 25 years, looked at 3 million managed transactions, and we're pretty confident that good equity managers have good stock selection skill. But what they're not so good at always is portfolio construction, timing entry and exits, scaling positions they go through. We know that managers have a history of they sell winners too early, they hold on for losers for too long, all the basic psychological issues that all of us have. So we've got to the point now where we just do what we think they're good at. We control the risk, we construct the portfolios, we do the on behalf of managers. So when events happen, we either run overlays, we do physical changes in portfolios. So we're very clear. We hire managers because we're not going to choose whether we should be invested in Ford or GM or Westpac or CBA. That's the job of our managers. But we will then manage the risk around those portfolio positions.
Well, let's talk about the AI theme, because you touched on it, and it is, if anything, the fundamental, one of the fundamental issues that managers have to make a call on. Andrew, you spoke about betting on the users, not the creators.
Yep.
Chad, you spoke about the opportunities in infrastructure, the sort of the shovels and picks argument. So what I took out of your thoughts, Andrew, was real margin compression as a result of AI. So do you just want to expand on your thinking about AI and how it will play out?
Well, we're heading into a world where there's going to be too much compute. So compute's going to be oversupplied. And the point was, like back in the 2010s, these were amazing businesses. Meta is an amazing business in terms of what it was able to do. Amazon with the cloud service, with the online sales, these had moats. So the key word to think about tech is a moat, because the tech guys love talking about where, and this is what protects you from competitive moats and economies of scale. And AI has neither of those things. So there will be AI winners and AI losers, but to my mind, it's going to look like a pretty competitive market. Like, I don't care whether I fly Virgin or Qantas. They're giving me basically the same service. Do I really care whether I'm using Claude or Grok or ChatGPT? Well, maybe they're going to try and tie themselves into corporate ecospheres, but I think they're going to have a lot of trouble properly monetizing these tremendous technologies. And I think that's going to be the thing for investors to think. We've gone through the period right now, we're still in the establishment phase, and use the shovels and picks things. This is the analogy everyone loves about the gold mine.
Yeah.
And we're going through that phase. NVIDIA is the classic shovels and picks seller, and it will do well. But to justify NVIDIA's current valuation, they had a great earnings report the other day. The share price hardly moved because what's embedded into the price now in terms of future earnings is just so high that it's hard to be more optimistic than the current price says. Now, the current price may well be correct. I think the other thing to keep in mind about AI is it's not a linear thing, it's exponential. It's a bit like, with COVID. COVID was exponential, it wasn't linear. No, they're not great comparisons, I know. But in terms of thinking about how quickly it's going to take everything up, how quickly it's going to be changing a lot of the things that we see and do. But it's going to be very hard, I think, for any individual AI player to have a sustainable competitive advantage, which will allow them to charge sustainably high margins in the way that Apple, Meta, Alphabet were able to do over the last 15 years.
My own view is my use of search engines, which predominantly Google, hasn't changed that much. And what they've done is embedded AI in Google. I use Claude most days. I think it's fantastic.
But Toby, the point is, like, Google's great because it doesn't work perfectly. So Google makes money because it can advertise. But if I go into ChatGPT and I want to get the cheapest flight between Sydney and Melbourne, if it sends me to a website, a sponsored website, then I'm not using that AI anymore. I expect that AI to give me the cheapest flight between Sydney and Melbourne. How do you monetize that?
Yeah. Yes, that's a good point. And that's one of the points that I perhaps came out of the Citrini report, which so many people have read and discussed, which is if you don't have time to check all the flights yourself, your AI agent almost certainly does have that time.
And it will be free. But the Citrini report had terrible economics, but it got that point right.
Yeah. Yes. I was reading Scott Sumner, who's a monetary economist at George Mason, I think, who did an economic analysis of the paper. But I still think that the fundamentals of the paper have a lot to commend them.
The idea that AI is going to get rid of those frictions that make certain companies survive is a point worth taking heed of.
Yes. Well, let's talk about one of the other major issues that faces global equity investors, and you both touched on this, and that's China. There's a question from the audience, which is, in an age of deglobalization, if China's exports are reduced, and you touched on the tariff barriers, Chad, and Chinese population is materially overestimated, as has been argued, so domestic consumption will underperform. What is your outlook for China as an investment direction? I mean, Andrew, you were quite bullish on it.
Do you want me to go first, Toby?
Yeah.
I'm not super bullish on it because I think that China's economy is in for a long-term problem. Like, Xi Jinping has got this crazy idea that production is virtuous and consumption is frivolous. Right? And when he talks about consumption, he actually means capex. He doesn't actually mean people going out and buying things in shops. He's never supported that, and it feels like he's in charge. They won't support that. They're running the biggest current account surplus in dollar terms the world has ever seen, and that's not about to get smaller despite tariffs, because that's the fundamental fact when you run a high savings economy. You end up with that outcome. So I think China is going to be tough from that perspective, but what China's doing really well, but they're making far too much of it, is tech. So the things that have done well in the Chinese share market over the last year have been the tech-related sectors, and that will still be the case. So I think for an MSCI China investor where you get different sector exposures, I wouldn't invest in the broader Chinese economy. I don't think that's going to be a happy place to be. But I think investing in certain sectors within which are overrepresented in H shares or MSCI China, that should be okay. But I think we saw some of the best returns we'll see over the past year. So I like it, but I'm not in love with it, and I don't think it's. And I think it will be okay, but it's not going to be the greatest. But because it's an emerging market, and I like emerging markets in general because the US dollar is coming down, and China's about 50% of the EM equity index, I think that's your main case for liking it right now.
So Chad, how does Global X see the Chinese investment opportunity?
Um, there's a couple of ways on an ETF basket basis that we access Chinese equities. I like the differentiation between MSCI, China, H shares, and so on and so forth. On our side, I think our proposition is China technology names, national champion names that intersect with government policy. So it's very much a planned economy. Are the names, if any names, to play? On the consumption side, for a long time, we've been interested in that story of the Chinese consumer growing. But as Andrew indicated, there needs to be an internal rebalancing within the Chinese economy for that to occur. So in terms of the marginal propensity to consume in China, it's very, very low compared to developed markets. And the reason for that is the government prioritizes, again, as Andrew indicated, production in investment. And so that kind of subtracts and detracts from the consumption side. But we know that China is very much engaged in developing its economy on a high technology side. And as an example, I said robotics or humanoids. And that's an interest area for us on our Mirai asset side, especially. We did have interest in electric vehicles, but there's such intense competition domestically as well as the export prices externally that it talk about margin compression and things like that. And the notion of involution, which is, again, suffice it to say, intense competition. So you have a lot of prices going down. That's why you're seeing deflation, disinflation trends in China. It's actually interesting, the juxtaposition between the idea of inflation in developed markets being a bit higher versus in China, the experience is the mirror opposite. And through export pathways, that's one way by which they're attempting to alleviate that deflation trend. Tariffs aren't going to necessarily remediate imbalances because you can have transshipments and so forth. But I think at least it's an indication that imbalances are on other economies' minds. We're still excited, though. Again, I think even in spite of geopolitical competition and the like, that markets find their way through that. And as Andrew indicated, from fixed income to equities, these are cash flow instruments, earnings instruments. And so just focusing on cash flow growth, earnings growth, revenue growth, the fundamentals is a good thing. Being broadly diversified and maybe having a pocket in the portfolio for something of a satellite expression for interest areas that you have, that you believe are tailwinded by growing addressable markets. You can add as an addendum to your core diversified mix. But yeah, no, the world is certainly changing, but we're excited about it.
Yeah. So let's wrap up today's session by just thinking broadly about a global equity exposure in a diversified portfolio, and how you think that will evolve over the next year or two.
For me, I think the main thing is it'll be less US. So moving away from US, having the US as a smaller part of that portfolio, I think it's part of the thing. I think over the next year or two, the downward trend of the US dollar makes international investing non-US look better. It certainly helps emerging markets exposure as well. And the other thing to think about with the national portfolio is your hedging stance. I think generally for most clients, you probably want to start off with a 50-50 hedge ratio. But if you're feeling a little bit bolder about that, you might want to stay a little bit hedged for a bit longer because firstly, you're getting paid to hedge right now because of the interest rate differential. And also the Aussie dollar does have a habit of overshooting, and commodity prices are on the rise. So I would warn that the two biggest commodities that Australia has, iron ore, is going nowhere because of the weak Chinese economy. And coal has had a bit of a rise, but it's a matter of how much further they can go. The big things that we've seen rising aren't big exports for Australia. But I would say the Aussie dollar's probably got a bit of overshoot potential. So maybe hold on to hedge ratios to that and maybe hold on for the interest rate differential story. But at some stage, as the Aussie dollar gets more expensive, start thinking about winding back some of that hedged exposure.
Chad, what's your view of how the global equity portfolio will look like?
I agree. I mean, much of my view is compatible with what Andrew just enumerated. On a currency hedge basis, what I would say in terms of overshooting, positioning is such that there's an anticipation of overshooting. It's almost as if allocators want the AUD to do exactly that. So we'll see if it occurs. But again, currency hedging is in fashion. We'll see, though, again, because commodity demand through China is not what it was during the boom. And so what is the implication of that for the AUD as a tailwind to the AUD? I'm a little bit doubtful about. On a global equity basis, I would say growth at a reasonable price stock selection makes sense. So global equity basket that stock selects companies with regard to attributes of growth, so growing earnings per share, but also on a valuation-minded basis. So it's a middle ground. You're not necessarily dispensing of growth. You're not necessarily not incorporating valuation. So a GARP approach to global equities is something that we think makes sense.
Great. Look, thank you very much, both Andrew Pearce from Russell Investments, Chad Heitzman from Global X. Thank you very much for your time today. And to those of you who joined us today, thank you for your participation. I hope you found this interesting and an insight into how advisors and portfolio managers might think about the structure of global equity portfolios. Tomorrow, we'll conclude this series with Andrew Stewart from Mercer, Tom King from Nanook, and we'll take a third perspective on global equity investing and the implications for that of the events in the Middle East. So, Andrew, Chad, thanks for your time today. And to those of you who've joined us, we'll look forward to talking with you again tomorrow. Great. Thanks very much.
Thanks.